Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about HANSOH Pharmaceutical Group Company Limited Annual Report. HANSOH Pharmaceutical Group Company Limited offers a diverse range of businesses and services in the pharmaceutical industry. At its core, the company engages in research, development, production, and sale of various pharmaceutical products for treating different diseases. The company's product portfolio includes medications for therapeutic areas such as anti-infection, central nervous system, oncology, metabolic disorders, autoimmune diseases, and others. Some of its principal products include Amil, HANSOH Zinfu, Pulil, Zephe, and several other branded medicines. In addition to developing and manufacturing its own products, HANSOH Pharmaceutical has entered into license agreements with prominent pharmaceutical companies such as GlaxoSmithKline Intellectual Property, No4 Limited, Biotheus Inc., and Merck Sharp and Dome LLC, MSD. These partnerships enable the company to develop and commercialize innovative treatments for patients with specific conditions. The company's services include product development, manufacturing, and commercialization of pharmaceutical products. Its research capabilities allow it to identify and develop new treatments for various diseases, while its production facilities ensure the quality and availability of these medicines in the market. HANSOH Pharmaceutical Group Company Limited market capitalization of $223 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that HANSOH Pharmaceutical Group Company Limited holds a significant advantage in their industry. HANSOH Pharmaceutical Group Company Limited trades at a higher price-to-earnings ratio of 34 times and a higher price-to-book ratio of 5.43 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 9% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The financial performance of a company has shown a decline in recent years. A significant drop in net income was observed, with a decrease of 12%. This reduction is substantial and warrants attention from investors and stakeholders. Furthermore, the profit margins have also taken a hit, decreasing by 8%. The decline in both net income and profit margins suggests that the company's revenue growth has not been sufficient to offset increasing costs. This trend may indicate underlying issues with the company's business model or operational efficiency. The company's financial performance indicates a strong ability to generate cash from its operations. This is evident in multiple sections of the report, where it is consistently stated that the company has achieved a net cash inflow from operating activities. Specifically, page 26 reports a net cash inflow of RMB 6,738 million for the year ended December 31, 2025. Additionally, pages 88 and 142 provide further confirmation of this trend, with cash generated from operations and operating cash inflows both exceeding RMB 6 million. The company's positive operating cash flow is also reflected in its net operating cash flow, which stands at RMB 31,240,423, page 153. Furthermore, the liquidity planning tool on page 160 explicitly states that the company is generating positive operating cash flow. These multiple confirmations from different sections of the report demonstrate a clear and consistent trend of strong operating cash inflows, indicating that the company is indeed generating positive operating cash flow. Management is emphasizing a long-term growth strategy that prioritizes innovation and patient-centered development. The company's focus on innovative medicines has led to steady growth, accounting for over 80% of total revenue. To sustain this momentum, management plans to launch new products, expand into new markets, and invest in research and development (R&D) centers and production lines. A significant portion of the net proceeds will be allocated towards R&D, with a focus on upgrading existing facilities and constructing a new global R&D headquarters in Shanghai. This investment is expected to enhance smart manufacturing capabilities through digitalized equipment and expand commercial production lines. In addition to its business strategy, management is also prioritizing sustainability and environmental, social, and governance (ESG) considerations. The company has established an ESG committee to guide its vision, objectives, and strategy, which will focus on identifying key issues and implementing countermeasures to address climate change risks. Concerns about inventory buildup and supply chain disruption are evident in various aspects of a company's operations. One key concern is the impact of global trade frictions on raw material costs and supply chain stability. This could lead to production instability if raw material supplies are interrupted. Furthermore, an analysis of inventory levels reveals a significant increase in work in progress by 30.4%, while finished goods decreased by 9.2%. This suggests that there may be issues with inventory management, potentially leading to buildup or inefficiencies in the supply chain. Additionally, increased costs of sales and selling and distribution expenses have been noted, which could further exacerbate concerns about supply chain disruption. These factors collectively indicate potential vulnerabilities in a company's ability to manage its inventory and supply chain effectively. That concludes the financial summary for HANSOH Pharmaceutical Group Company Limited. Feel free to comment below, and I will be happy to answer them when possible.